Eric Muathe with Muathe.com. Let's take a look at the chart for UNG. This is a daily view, and we can see for today it's down about 4%. And the key here also is we can see that this is consistent with what we know, that when stocks trade below 30.9 on the daily RSI, bad things happen. So this drop is not a surprise. But the reason for this video is to explain to you why we were on the bearish side at these higher levels at above $9. Number one, we can see here there was a breakout attempt that failed. So on a daily chart, that was a problem. We also had seen that there was an attempt to move higher at the time that came with declining RSI strength. So that was negative divergence. So lots of things were going wrong during this breakout attempt. And keep in mind, whenever you see a failed breakout attempt, it tends to suggest that the stock or an instrument or ETF is running out of energy, and chances are there's a reversal even as the stock is trying to attract buyers. As you can see here, this was a one-day breakout that failed. Now if you go to the weekly time frame, you can see this clearly. Take this weekly closing high here, and that was at a price of 9.43. You can see that this breakout attempt failed here. Let's call that in about December. And we can see another failed breakout attempt here. Now, since those two breakout attempts, you can see what has happened is that the stock has drifted lower. So no surprise, failed breakouts are notorious for taking markets lower. Also, the key reason why we suspected this was going to be a reversal area at the highs there of about $9 was that the stock had come back to this level, and we can call this level at about 61.8 on the weekly time frame. So natural gas was coming to that level, and it hit that level with uniform action, which corresponds with this break. So that RSI break in, let's call it about July, was a problem since we saw a pullback from about 875 all the way to the lows here of about 750. Ultimately, since then, this has been reversal territory. Uniform activity rejection here for the highs there. Uniform activity rejection here for the highs here. And again, could not get back to that red line. So that was the main reason why at those levels we were bearish. So at this breakout attempt here, definitely the stock was giving us a red flag due to the failed breakout attempt, and also because of the resistance at this level here. So the pullback is not a surprise. But where does this line also show its rejection power? So we're talking about this red line at about 61.8. So let me show you where that line comes from. So we're talking about this level here, 61.8. That gave us the red flag. So you have to go about 5 years on the weekly time frame, which is what we were looking at. By the way, here is the 2-year weekly time frame that clearly shows that around here this level has been a problem for natural gas. Going back to the break here, rejection, 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 and again rejection. So anybody who was paying attention to that could have suspected that with that failed breakout here, chances that the next direction was going to be down. That's exactly what has happened. So let's take a look at that 5-year weekly chart, and I'll show you where that line comes from. So we're talking about this break. Once we break down here, we come off the highs. We draw a line from there, which is the same line that we've been drawing on this video. So we can see that line also happens to be at about 61.8. And you can see since this line here has been giving us uniform activity rejection and giving us short-term highs as far as natural gas is concerned. So once we fail to break out here, you can see that that was telegraphing this drop that we've seen over the last couple of weeks, last couple of months. And again, this line so happens to be at about 61.8. Now there's another view that we were looking at the high. So we're talking about these highs here, and it is based on the monthly chart. And again, it's the same method, which I call the uniformity method. You can check the description for more details about this method, but you can see that there was a break here. And so what we did is we took this line here because it gave us a break of the highs here. We use that information. Here we have uniform activity resistance, which is this high. So the high that was recorded and the subsequent drop over the last 2 months is pretty much in running with what we were expecting with this uniformity line. Where does this line come from? You have to go and take a look at the long-term monthly chart. This is all data monthly, and you can clearly see that the line corresponds with this break. Once we broke down here, we came off the highs here of 2014. We draw a line from there. We were expecting resistance. Why? Because of uniformity. Again, check the description for this method. Once we hit that line with uniform action, the stock has been straight down. Keep in mind now the risk is for lower prices if and when, again, if and when it moves below 30.9 on the monthly time frame. So the RSI holding below 30.9 would suggest even lower prices. We shall see how it goes, but here this video was trying to explain why we were thinking the instrument could pull back. If you go back to the highs, as we can see on this 1-year weekly chart, here is where we started expecting a pullback as far as natural gas is concerned. So we looked at failed breakouts and RSI uniformity methods, all of them indicating that there was what looked like the possibility of a pullback based on resistance. So this most recent move of the last 2 months is consistent with those previous red flags. Eric Muathe with Muathe.com. As always, good luck, peace and blessings. ESC. Woo!